What's going on, guys? Welcome back to a new video. In this video we're going to be talking about the basics of stocks, everything you have to know, going through where to find them, how to analyze them, and determining buy price for these stocks. Also, we're going to discuss some of the platforms that you would want to use for all of these things. So first of all, if you would like to check out my platform, which is created by me, which I created from my own personal investing, just go to this link. It's a little complicated. It'll be in the description. You can just sign up. So just click on sign up, and then you can just sign up normally. Now, I'm just going to sign back into my account, and we're going to go over the basics of investing. So first of all, we're going to go over how investing actually works. Now, if you already know this, you can skip this part of the video, but basically what I have here is just an empty notepad. And what I'll show you is, let me just zoom in, and let's say that you pay $100 for a company, right? This is the cost. So let's say that you pay that $100, and the company makes $10 per year for the next 5 years. So let's say that they make $10 per year. Actually, let's say that they make, let's say that they make 10. That seems about right. And after these 5 years, you sell it for, let's say you sell it for 30. What this means is that you paid $100 for a company, and then got $50 from the 5 year and sold it for another 30, which means you're in a negative return of $20 in 5 years. Now, let's say that this company was to make $20 a year and you would sell it for 50. Now, you would make, what is that? $150 from that 100. In 5 years. That means you would achieve about a 8%, what is it called? Interest rate on your money per year annually, right? Because you went from 100 to 150 in 5 years. Now, this is not that great, but this is just about the average that the S&P 500 does. It's just like 8% or something. Per year over that's the average of over the last like 10 years. As an investor, you would like to achieve at least 10 or more percent. It of course depends on your goals, and of course your age and everything, your financial, position. However, you would like to achieve more than just 8%. So you want to find companies that can give you more value. And investing is about finding companies that you can buy for as low of a price, and they will generate as much cash by paying you dividends, or maybe you can sell them for more. Now, there's companies, basically, this is divided into two categories. The stocks are divided into two categories: the dividend stocks, and then just the growth stocks. The dividend stocks pay you a dividend. Most stocks pay it 4 times a year. Some pay it, some pay it in the second quarter and fourth quarter. Some pay it yearly, some pay it monthly, but that doesn't really matter. What's important is the dividend yield, and the dividend yield is how much you get per year, and that's basically your return if you buy a dividend stock. So let's say that this company would basically just give you a 10% dividend, and growth stocks, you basically just try to buy the company for a certain price. So for example, $100 right here. and then it's gonna grow from profits of 30 to profits of like, I don't know, 70 in those 5 years. And then instead of selling it for 50, you can sell it for 200 because the profits have gone up and also the price has gone up. And then you'll make, I don't know, what is that, like 15% per year. Actually, no, that's, yeah, about 15% per year if this scenario was true, right? Uh, so these are usually dividend stocks are usually safer because you will always get the dividend. It's of course important to check whether the company can afford the dividend, and these growth stocks are a lot less safe because you don't really you can't be sure that they're gonna grow. But there are other things that you have to consider, of course, especially with growth stocks, because you're basically trying to look for a stock that has good fundamentals and good financials and has a good business model. And that's basically what you're looking for. But now let's talk about where you can find these stocks, because that's actually really important for investing. So I suggest one of two things. You can either get the stocks from YouTubers, right? So you're watching their stock analyses, like for example mine. I have a bunch on my channel, so you can go watch them. And some of the stocks I found really interesting, so you can just go and watch some of those. Some of them are outdated, but I will make more in the future. So, but the second thing that you can do is actually go to TradingView, which is a free platform. You can create an account and then go to the stock screener down here. You can just pull that all the way up, and then you got these filters here. Now, investing doesn't just require you to look at the company's future earnings to determine what you want to pay for it today. That's basically the basics, but there are ratios that can basically help you with analyzing a company. So I like to use a ratio called the price to earnings ratio. I think it's going to be like this price to earnings ratio right here. And for example, you can only search for companies below a price to earnings ratio of 10. So you can see that we got 2,000 results. And then, so you can do whatever you want here and search for companies that match what you want to see in your, I just canceled it, in your, what companies that you're looking for. You can even filter by market cap. So if you only want big companies, and then you can also screen by things like the growth of the company. Oops. So you can use the year-over-year revenue growth. So if you want that to be above 5%, right, these companies will have that. Now, there will be a lot of duplicates here because they're on different markets, right? So this one might be on the New York Stock Exchange. This one might be on the whatever German Stock Exchange or whatever. So you will get duplicates. However, this is a very good method of screening for stocks, because you can basically look over the entire market, right? So basically all of the stocks that exist are here on TradingView. So there were like 18,000. If I just cancel all of these, you can see that there are 18,000 tickers here. That doesn't mean they're all just companies. There might be some duplicates, as I already said. However, you can see that most of these, so you can see there's a duplicate here, but most of these are just singular companies. So there are really a lot of these, and you can just search for all of them. And the third part is, once you find something that you like, for example, something that has a P below 10, something that, I don't know. So then you can just copy the ticker and go into here Agilent Technologies or whatever. Agilent Technologies, I don't know how to pronounce that, it's fine. And then you can analyze it using either the TradingView platform right here, but what I like to use is actually my own platform, which you can go to this link, as I said, sign up for free, and then you can basically analyze your companies here. Now, you can basically just follow along what I do, and you'll be able to do everything I do on my platform, of course. Now, some of the things are not yet finished, like for example, here in the overview, only the valuation is finished. However, I am working on that. So yeah, but the charts are already finished, so we can go ahead and look at all the charts. So I will also add statements, right? So the income statement, balance sheet, all of those, I'm working on that. However, they're basically already in all of these charts. So let's take a look at these charts and what to look at when we analyze these companies. So there are like patterns that you can look at, but I just believe that that's kind of bull crap, and what you should actually be looking for, just the main thing here, is the growth of the revenue, the growth of the earnings, and a stable or growing profit margin. Now, the profit margin is just basically the revenue or the earnings divided by the revenue, which basically means how much what the percentage of the revenue goes towards their earnings, right? So basically, if a company sells a product for $100, right? Let me just delete this. So if a company sells a product for $100, and then I don't know, 25 of that, or $20 of that, 20 percentage points of that go towards employees. So you pay employees 20%, and then 30% goes towards the product, right? The product. Then you're left with $50, and that means you have a 50% profit margin, because 50 divided by 100 is 50%. And that's basically what the profit margin is. It's pretty simple. However, it's very useful because businesses with a high profit margin are way likelier to survive in crises, because let's say that a company sells a product for $100, right? And then when inflation comes in the crisis, they might have to sell that product for less in order for people to buy it, and that will really cut into their margins. So things like or companies like car manufacturers or like grocery stores have really low profit margins, and when the crisis comes, they basically just can't do anything, and they report a loss in the year. So for example, Agilent Technologies, whatever, actually in 2020 the results are pretty good. But if you look at something like what, I don't really know now. Let's just look at like Walmart. Is Walmart a thing? I don't know. You'll see, like, if we go to Tesla, for example, that in 2020 they have a loss because people just don't want to buy cars. Of course, they do have a loss in 2020, but this is due to just inflation. The huge inflation, and Tesla just had to deal with it. They lowered their prices also. So anyways, but if we look at a company like Apple, you can see that their profit margin is very stable, and even through 2020 they have made it through. So you're looking at companies like this. Now, there are a lot more of these charts that you have to consider. I'll just go over a few basics. Like, this is the price to earnings ratio that I've been talking about, And then I won't go over those because they're kind of complicated and they don't really matter that much. However, this one is very important. This is the cash compared to the debt plus the free cash flow. The free cash flow is kind of similar to the earnings. However, it's basically the entire cash that they've made minus the entire cash that they've spent. So it's basically their earnings plus things like buildings they might have sold and other stuff like that, minus I don't know, investments back into the company, right? And then so that's compared to the cash and debt. And this chart is extremely important because it shows you whether the company is in a good financial situation. So, for example, Apple here has way more cash than debt. So that's great because it can basically pay off its entire debt immediately, which you're looking for, of course, because companies like this won't have any problems in crisis. So many of the famous investors actually said that it's very hard to go bankrupt if you have no debt, right? And now let's look at the shares outstanding chart. This chart is ultra important. Now let me tell you why. So the shares outstanding chart is very important because if a company has 100 shares and you own 10 of those shares, you own 10% of the company. That means you are entitled to 10% of the dividends. Now, if the company buys back 20% of the shares, now they only have 80 shares. You still own 10 shares, right? So now you own 12.5% of the shares. That means now you are owed 12.5% of the dividends. That's kind of huge because you don't have to do anything, and the company kind of just gives you more money by buying back their shares. And you just own more of the company. Now, the assets and liabilities chart is also very important because it shows you the development of the assets and liabilities. Now, this is important because this gap between the assets and liabilities is called book value, and it's basically what the company is worth. So if the company has more assets minus liabilities, so basically the equity, this is the equity or book value, then what it costs, right? So let's say that a company has costs $100, right? The entire company. And it has $200 in assets and only $50 in liabilities. So that is $150 in book value, and it means that the company is 50%. So if you would buy the company and then sell all its assets and liabilities, because you can't just go bankrupt like that. So you'll basically sell all of the assets and pay all of the liabilities. You would get 50% because you would get that extra 50, right? And that's basically how it works with book value. So this is great to look at. Also, it basically just shows you how the assets are, if the assets are growing and if the liabilities are falling, which basically just puts the company in a better financial position. And now let's talk about the ratios. Now the charts inside the ratios are a little bit more complicated. However, especially this one, this is return on equity, return on assets, and the return on invested capital. So these metrics are actually incredibly complicated. However, a simple way to look at them is basically the cash that you get for the equity. So that's the equity, the return on equity, pretty much is what it says. And this one is pretty complicated, but I won't talk about it. However, I definitely will talk about the return on assets. Now, this one is very easy to understand. If a company has a restaurant, let's just go in here. So if a company has one restaurant, and that restaurant costs $1 million, right? and the company makes $200,000 per year, right? That would mean that the return on assets is 20% because it makes 20% from their assets, which is just that one restaurant. So that's basically the oops. I always go to the OBS thing. So that's basically return on assets, and then return on invested capital is just the same, but it's the return on the invested capital that year. So it's the entire capital that you have invested. And then the return on equity is basically not, it's very similar to the return on invested capital. However, it's not the return on the entire invested capital, it's just the return on your invested capital. That means if a company takes, it wants to buy a restaurant, right? So it, so it basically just pays down 500. That's supposed to be $500,000. So it pays down $500,000 and takes $500,000 in debt, right? And then it buys a restaurant for $1 million. And then it can make those $200,000 from that restaurant. Now, the return on equity here would actually be calculated from this. The return on, so that would be 40%. The return on invested capital would be calculated from the entire capital invested, including the debt. So that would be 20%. And the return on assets would be calculated from the assets. So right here, 20%. So that's these three metrics. Why do I always go there? That's those three metrics. Now, very simple, dividends and payout ratio. The dividend is basically just the yield that you get, the dividend yield, right? And the payout ratio is how much of the company's earnings go towards the dividend. So very easy there. The change in investments is actually also pretty important, and it's also pretty easy to understand. It's just basically the changes in the investments. I know that seems dumb, but it's just basically, it shows you if a company has invested some of its money or sold some of its assets, right? So I won't really go over acquisitions. It's a lot complicated, but doesn't matter really. And then the calculator here, this segment is basically, well, it's a calculator for the intrinsic value of the company. What this means is that it calculates your buy price. So if you think that Apple is going to grow 8% per year, so you can make three scenarios, the low, mid, and high. So if you think Apple will grow 8% per year, you can say that it'll grow from 6 to 10, right? And then for the profit margin, you can say, I don't know, you think Apple will have a profit margin of 26%, so you'll just go 24, 26, 28, for example. So free cash flow margin, you'll go something like the same. You'll go 25, 27, 29. And you want to basically deduce it one off the 10-year, and the PE you want to deduce off the market average, right? Because you're kind of comparing the company to other companies. So for this, we can go for like, I don't know, 16, 18, 20 for Apple, because usually it sells for quite a premium. So let's go for 16, 18, 20, and you can see that Apple is actually extremely overvalued according to this calculator, right? Which was expected. But this, of course, depends what you would like to get for your money. So if you're fine with a 7% return, you would be pretty much be good buying it at this price if these metrics become true. And that's basically how it works. And then you can just add it to your watch list. Make sure this is unchecked if you want to input your own price. So you can just add your own buy price. So if you want to buy it at like 120, or maybe you want to buy it at 160, who knows? And then you can basically just add it to your watch list. It's already in my watch list right here. at 115. I know, pretty naive. However, I don't think it's gonna get there. Um, so I'm probably never gonna buy it. But I just think that Apple is very overvalued right now. And yeah, that's basically how it works. If you want to check out this platform and follow along, go to this link. I'll make sure to leave it in the description. But anyways, guys, I hope you enjoyed, and I will see you in the next one.